Looking to build a dividend income portfolio? Want to add a few real estate investment trusts or REITs to your income portfolio? This video will be breaking down two REITs that pay consistent and stable monthly dividends. Both of these companies are currently trading at a huge discount from their all-time highs. They also haven't reduced or cut their dividends and don't plan to in the near future. My goal here is not to earn dividends with a stagnating stock price. I'm looking to earn capital appreciation on top of the dividends I'm earning. Please make sure to watch my previous video on my two favorite Canadian REITs, as well as a breakdown of real estate investment trusts if you're interested. I know this gets annoying hearing it from every YouTuber in every video, but please thumbs the video and subscribe to the channel for more content. The first stock I'm recommending today is REIT, Canadian Apartment Properties Real Estate Investment Trust, one of the largest apartment rental REITs in Canada. They own multi-unit residential properties earning rental income. Taking this quote directly from their website, their objective is to provide long-term, predictable, and stable monthly cash distributions. What more could you ask for? As of Q2 2020, they own 56,800 rentals in Canada, with another 5,600 in Netherlands and 3,700 in Ireland. The current stock price is $47.35 with a modest dividend of 2.91%, and they pay monthly distributions. The REIT hit all-time highs pre-crash of $61 per share, quickly dropping to $36 and slowly climbing back up. The massive drop in price was obviously an overreaction to the market news. It wasn't based on a fundamental flaw in the business or a massive drop in rents or occupancy. It's why I think everyone should try to get this stock right now while it's still at a 20% discount to its all-time high. If you invest $1,000 right now, you'll get $29.10 per year in cash dividends, or $2.42 per month. Taking a look at their most recent results, REIT has maintained a high occupancy at 98%. This is slightly down from last year, which was 98.3%. Here's the caveat with this occupancy number. Evictions were banned by all provinces in Canada, so this might be an artificially inflated number. REIT might want to evict the tenants that are not paying rent, but they're not able to, even if they wanted to. So who knows what the true occupancy would have been if there was no ban. That being said, the eviction ban as of August 2020 has been lifted. So I really hope REIT doesn't start evicting people who can't pay rent just due to everything going on in the world. I do think companies will be better off in the long run if they are socially responsible. They might take a slight hit in the short term from their cash flows for not evicting the tenants who don't pay rent, but I do believe that in the long run they'll be better off. Back to their quarterly highlights. They have an increasing net operating income at $281 million, whereas many of their peers have had a lower NOI, like the two REITs I reviewed in the last video. They're reporting a very low 63% funds from operations payout ratio and 62.8% normalized funds from operations payout ratio. If you watched my previous video, I mentioned that the income statement numbers aren't as important in a REIT as the reoccurring cash flow or free cash flow. These two indicators are unique to the real estate industry. They're basically saying out of 100% of the recurring cash from operations, they're only paying out 62% in dividends. This initially might seem high when you compare to certain Canadian banks, but note, the average in the industry is 80% or even 90%. The rest of the stats and ratios from the same image should give all investors comfort. Around $340 million in liquidity from cash or credit facilities, 36% debt to book value, and decreasing mortgage rates on that debt. Without spending 20 minutes analyzing every page of this 98-page quarterly report, for the purposes of this video, my personal recommendation is that this is a great stock to pick for any portfolio, not only a dividend growth portfolio that you'd want to build. You not only get a modest dividend yield, but you'll also get great upside for potential capital appreciation as well. My second recommendation is First Capital REIT. Before I get started, I'd just like to disclose that I used to work at this REIT for 3 years in their financial reporting department. I created these statements, and obviously these are the statements I'll be reviewing today. I'll be sticking purely to what their quarterly report states, and I won't be giving any other insider information. Also, if you work at First Capital, just turn this off. Turn it off. First Capital is currently trading at $14.92 per share with a yield of 5.77%. They pay monthly dividends. Until this year, they were called First Capital Realty. The dividends were paid quarterly, but they had to convert to a REIT probably for tax purposes. They were trading at a 52-week high of $22 per share and quickly tanked to $11.09 during March 2020. They've been slowly climbing back up ever since. Like the previous REIT, I do think that this was an overreaction and the shares are oversold. I doubled up on my investment when it dropped to $12. I still think there's a potential 50% upside if you're able to buy and hold the shares at today's price. If you were to invest $1,000 right now, you'll get $57.70 per year in cash dividends or $4.80 per month. Their head office is located in Toronto. It's actually just right outside this window. They have over 4,000 tenants and are in 149 neighborhoods. Not sure why they don't just tell us how many properties they have instead of just neighborhoods. It's easy to recognize a First Capital Plaza. The main strategy is to have a grocery store as the main attraction of the plaza, and then surrounding it all other ancillary and everyday stores in the same area. Take a look at their tenant mix. 118 grocery stores making up 17% of rent. Then medical, restaurants, pharmacies, and banks making up almost 50% of their rent. The strategy is great. The company survived and even did well in the 2008 recession. The idea is that everyone still needs groceries, medical offices, pharmacies, and banks, so even during hard economic times, their tenants will still be around. They'll still be able to collect their rent. Let's quickly take a look at their quarterly highlights. Net operating income is down, but that is to be expected. Their debt to asset ratio is 47%. This means they have a lot of room to leverage their properties for additional financing if they're in a crunch. Total portfolio occupancy is 96.3%. Slightly down, but that's fine. The two important items I've mentioned previously are funds from operations and adjusted cash flow from operations. More specifically, the payout ratios for each. The ratios have jumped up a lot. They're both in the low 90s. That means they're paying, take a look at this, 91.9% of their recurring cash in the form of dividends. I'm not saying it's a red flag yet, but everyone should be monitoring this number on a quarterly basis and consider selling if this number gets closer and closer to 100%. One item that's frustrating and it's not financial related are the formatting errors. Because I used to create these statements, it's pretty easy for me to catch. You see here, it has some random font or formatting issue. It should be tax recovery adjustments, like this table on the next page. It's just that I know how many times these statements get reviewed and by how many people, so it's just annoying. All that being said, I still think this is a great company and I rate this as a strong buy for any portfolio, especially at this current price. That's it, another one down. Thanks for making it this far, and please let me know of any other stocks you'd like broken down. I'm hoping to put out one of these videos every week. They seem to get the best response and the most views and most traction. So thanks for watching. Let me know any other stocks you'd like. Thanks guys.